7 secret credit moves. Loan officers exposed to preferred clients. A retired loan officer showed me the exact steps banks use to pre-approve wealthy clients in 30 days flat. And the craziest part? He told me banks actively train their staff to never mention these strategies to regular applicants. His exact words were, "We had 2 playbooks, one for walk-ins, one for referrals from private banking." I spent 3 hours recording everything he said, and what he revealed about how credit scoring actually works behind the scenes made me realize that everything I thought I knew about building credit was designed to keep me in the slow lane. Here's what nobody tells you about credit. The system isn't broken. It's working exactly as designed. It's designed to reward people who understand the insider rules while everyone else follows advice that keeps them stuck at 680 forever. By the end of this video, you're going to know the exact sequence wealthy clients use to hit 750 plus in months, not years. You'll learn the specific credit card trick that loan officers call the velocity hack. And I'm going to show you the one move that can add 50 points to your score in 14 days, something banks hope you never figure out. But the 5th strategy on this list, that's the one that made me actually angry when I learned it. Because it's so simple, and nobody talks about it. So the first move wealthy clients use is something called strategic authorized user stacking. And no, this isn't just get added to your parent's card. That's the watered-down version banks let people talk about. Here's the real strategy. Marcus, this 24-year-old I know, had a 590 credit score 8 months ago. He'd missed a payment in college, had high utilization, the whole mess. His older sister had 3 credit cards, all open for over 7 years, all with perfect payment history, all with less than 5% utilization. Instead of adding Marcus to just one card, they added him to all 3 within the same week. Within 45 days, his score jumped 97 points. Not because of one account, because he inherited the average age of 3 seasoned accounts simultaneously. The loan officer I talked to said wealthy families do this systematically. They add their kids to old accounts when they turn 16. By the time those kids apply for their first apartment at 22, they already have a 780 score with a 10-year credit history. They never built credit. They inherited it. Now here's what you actually do with this information. You need accounts that are at least 5 years old, with perfect payment history and utilization under 10%. You can ask family members, but here's something most people don't realize. There are also legitimate services where people with excellent credit will add you as an authorized user for a one-time fee. It's completely legal. Banks hate it, but it's legal. Just make sure they never actually send you the physical card. The second move is called utilization cycling, and this is the one loan officers privately call the velocity hack. Most people think credit utilization is calculated once a month when your statement closes. That's technically true, but here's what's actually happening behind the scenes. Your credit card company reports your balance to the bureaus on your statement closing date. If you're carrying $2,000 on a card with a $3,000 limit, that's 67% utilization, and your score tanks even if you pay it off in full when the bill comes. Wealthy clients know the exact date their statement closes, and they pay their balance down to under $100 3 days before that date. This means when the bank reports to the bureaus, it shows 3% utilization instead of 67%. Same spending, same payment behavior, radically different score. I tested this myself. I had a card with a $5,000 limit, and I was spending about $3,500 a month on it for business expenses. Always paid in full. My utilization was showing 70% on my credit report, even though I never paid interest. I started paying it down to $200 5 days before statement close. My score went up 34 points in one billing cycle. One billing cycle. The loan officer told me their preferred clients, the ones getting approved for $500,000 mortgages at the best rates, they all do this automatically. Many of them have their assistants handle it. But here's where it gets interesting. You can actually cycle your utilization multiple times per month to maximize your available credit. Pay down your balance, let the credit free up, spend again, pay it down again before statement close. Banks see you as someone who manages credit responsibly, even if you're spending more than your limit technically allows. Now, this third move is the one that changed how I think about credit forever. And honestly, it made me frustrated because it's counterintuitive to everything we're taught. It's called the ASIO method, all zero except one. Traditional advice says keep low balances on all your cards, maybe 10% on each. Spread it out. Sounds reasonable, right? Wrong. Credit scoring models like FICO 8, which is what 90% of lenders use, actually reward a specific pattern. All cards at zero balance except one card carrying a small balance. We're talking like $10. Not 10%, $10. The loan officer explained it like this. When all your cards show zero, the algorithm can't see active credit management. You look dormant. But when one card shows a tiny balance and everything else is zero, you look like someone who uses credit strategically and maintains control. A woman named Priya I connected with online was stuck at 721 for over a year. She had 4 credit cards, all with small balances, all under 10% utilization. She was doing everything right. She tried ASIO for 2 months, let 3 cards report at zero, kept $15 on the 4th. Her score hit 758. If you want more strategies like this, the real tactics that actually move the needle, hit subscribe. I drop one of these every single day. Now when it comes to actually managing all these cards and tracking statement dates, there's a learning curve. I've been experimenting with tools that help automate some of this tracking. There's this platform at try.11labs.io/2pu10009y92jl1 that I've been using to create reminders and organize my financial content. Worth checking out if you're serious about building systems around this stuff. The fourth move is something you can literally do today, right now. It's called rapid rescore dispute targeting. Here's what most people get wrong about credit disputes. They just blast disputes at everything negative on their report and hope something sticks. That's amateur hour. The wealthy clients, they target specific types of negative items that have the highest removal rate. Medical collections under $500. Paid collections that weren't removed after payment. Hard inquiries that are approaching 12 months old. Late payments from accounts that are now closed. The success rate on these specific dispute types is dramatically higher than random disputes. I'm talking 40 to 60% removal rates versus maybe 10% for generic disputes. Here's your action step. Pull your free credit reports from annualcreditreport.com tonight. Not the scores, the full reports. Look specifically for medical collections under $500, any paid collections still showing, and hard inquiries older than 10 months. Dispute those first. Write specific letters, not generic templates. Reference the FCRA and request method of verification. Most people see results within 30 days. The fifth move is the one I mentioned earlier, the one that actually made me angry. It's called credit limit optimization, and it's so absurdly simple that I couldn't believe it works. Every 6 months, you should be requesting credit limit increases on every card you have. Not because you need more credit to spend, because higher limits instantly lower your utilization percentage. If you're carrying $1,000 on a card with a $2,000 limit, that's 50% utilization. But if you get that limit raised to $5,000, Same balance is now 20% utilization. Your score goes up and you didn't pay off a single dollar. Here's the insider part. Most credit card companies let you request increases through their app without a hard inquiry. Chase, American Express, Discover, they all do soft pulls for existing customers. But, and this is crucial, Capital One does a hard pull every single time. So does some store cards. The loan officer told me wealthy clients have their accountants request limit increases systematically every 6 months on all soft pull cards. They never ask for more than a 30% increase. They always do it after 3 months of low reported utilization. They wait at least 6 months between requests on the same card. This slow, steady approach means their limits compound over time. Someone who starts with $10,000 in total credit can have $50,000 or more within 3 years without ever applying for a new card. Remember when I mentioned the authorized user strategy earlier? Here's where it connects to moves 6 and 7 for maximum impact. Move 6 is called credit mix acceleration. FICO scores factor in your variety of credit types. Credit cards alone will only get you so far. You need installment loans in the mix. But here's the hack. Credit builder loans from companies like Self or MoneyLion count as installment debt. They cost maybe $25 a month. Report to all 3 bureaus and add that missing credit type to your profile. You don't need a car loan. You don't need to go into debt. A 12-month credit builder loan adds installment history, improves your payment history, and diversifies your credit mix, all for under $300 total. And the 7th move ties everything together. It's called score timing optimization. Your credit score fluctuates constantly, but lenders pull your score on specific days. If you're planning to apply for a mortgage, a car loan, or even an apartment, you want to know exactly when your score will be at its peak. That means you pay down all utilization 4 days before application. You make sure statement closing dates align so your lowest balances are reported right before. You pause any new credit applications for 90 days prior. The loan officer told me preferred clients schedule their applications around these cycles. They'll literally delay buying a house by 2 weeks to wait for their score to hit its monthly peak. So let's bring this full circle. That retired loan officer showed me these 7 moves that banks train their staff